Non, pas du tout. All right, good afternoon. It's hard to get people dragged away from the beautiful rooftop and sea view, but we'll try to keep that conversation energetic and for a post-lunch panel. So the next conversation is going to be around collateral mobility, blockchain's killer app. And on the panel, I'm happy to welcome Amy Denier, who is going to be moderating this panel. Amy, do you want to come on stage? And then we're going to have Chris Bruner, who's the CPO of Tradeweb. Chris, oh shit, she's not here. Okay. Oh, yeah. Chris is focused on executing the firm's vision for entering new markets and expanding Tradeweb ability on the blockchain. Welcome, Chris. Then we're going to have Mike Winnicky, who's managing director of the DTCC. Welcome, Mike. And Mike oversees strategic planning across the CSS business and industry engagements. Next up, we have Yuval Ruz, who is the CEO and co-founder of Digital Asset Canton, and Chris Zolke, who's the global head and CEO of Cumberland. Welcome, everybody, and have a good conversation. There you go.
Thank you. Hi, everyone. Thanks for being here. We should have had this panel on the roof. I think the attendance would have been even bigger. Thank you very much for being on this panel today. Collateral is a word that I hear a lot these days. And one of the problems that I hear is about how collateral needs to be available 24/7, but there are some roadblocks to achieving that. So how does the ability to move collateral 24/7 fundamentally change the way your firms think about risk and how you think about capital during the weekend and overnight?
I don't know, maybe I'll just jump in. So DRW and Cumberland, we're a large global proprietary trading organization. So the core of our business is finding trading opportunities, making sure they're funded appropriately and capturing them. And we've been operating Cumberland in a 24/7 model for 10 plus years now. And one of the fundamental problems we have is projecting our capital needs going into the weekends. If you ever have tried to do this, inevitably you just don't get it right. You either ask for too much and you end up paying interest on dead capital, or you ask for too little and you can't capture the trade. And so what we found is the ability to have a tokenized asset that is available for trade financing or repo, essentially into the weekend, brings us all the way to the efficient frontier of trade financing. So you're no longer worried about over or underestimating into the weekend. You are sitting in a yield-bearing asset up until the moment in which you want to deploy it as kind of a cash in order to capture the trade and then unwind it. And I think what's most interesting isn't necessarily the balance sheet efficiencies, which in and of itself is valuable. It's that the return on capital for us on a per trade basis goes up. Right? If my cost of capital goes down, each trade makes incrementally more. But what that does is it kind of creates a convexity effect, where we are now able to potentially go after trades that previously we couldn't justify trying to capture because the return on capital wasn't sufficient. And so as the financing charges goes down, ROC goes up, and inevitably you do more and more trades as your marginal cost per transaction goes down. So it's kind of really changing not only how we think about funding going into the weekend, but also the trades that we're able to capture as a result of improved funding rates. And I think that kind of projects into holidays, overnight as well. And so it's kind of just a much more efficient, much more enabling environment for us to trade within.
I just want to add, because Chris talks from a Cumberland perspective about the crypto market, which trades today 50 to, let's say, $300, $400 billion a day volume, depending on the activity. But within your question, there's this assumption that this is relevant potentially only for the after hours or the weekend. And what people don't realize is that collateral also within the trading activity day does not move in real time. So today, when you deliver collateral into a clearinghouse, it's twice a day. You can't just do it back and forth. When you send collateral to your prime broker or your FCM, you could do it twice a day. You can't do it intraday. So actually, collateral mobility has a dramatic effect, pretty much one-to-one with what Chris just said, even intraday. And I would say that when you apply it for traditional markets, the amount of usage that we can up in the market is quite dramatic. We did a study with true, very prominent trading firms that said if you could actually move collateral all over the world 24/7 in real time, actually not even 24/7, just during the trading day, they can see up to north of 50% uplift in balance sheet efficiency. So I just want to put it in perspective. If you're a hedge fund and you generate a $10 billion profit in 1 year, theoretically speaking, what they're saying is in the same year, they could have done $15 billion in profit or even more with the same balance sheet. They wouldn't have to call on debt. They wouldn't have to raise more capital. And that is dramatic. So yes, it's very easy to kind of see it in the after hours and the weekend because we can't move collateral, but even within the trading day, collateral does not move very efficiently.
Yeah, so maybe answering that from the perspective of both a CSD, right, and how we want to enable these use cases for our members. Absolutely, collateral efficiency is kind of one of the main reasons why our members are interested, right, in engaging with us and adopting a tokenization model that can enable this 24/7, but also real time, right, movement of assets. And I think the promise, right, of blockchain is that we should be able to take kind of these silos that we have today across different asset types, equities, fixed income, different regions, and break down some of these silos, right, that mean that they're moving on different infrastructure with different timing where you don't have that ability to do real-time optimization. And certainly DTC, is part of the infrastructure today, and to a certain extent, our traditional service hours are part of the problem, right? We go home on Friday and we turn off the lights, and if our clients have obligations that they want to collateralize or fund for a trading opportunity that is emerging on a Sunday, in another market, the assets they have at DTC are not mobile, right? So they have to wait for us on Monday, so they have to pre-position, like you're speaking to. But by offering our tokenization service, right, that does allow assets not only to move after hours and move 24/7, but in increasingly, globalized multi-asset portfolios, as other CSDs and FMIs kind of participate in these networks, allowing our clients to really optimize in the most strategic way the allocation of their resources across obligations without really having to optimize based off of who happens to be open and during what business day hours and conventions. But we're certainly also thinking about this from a CCP perspective and a trading perspective, because markets are moving to a more 24/7 capabilities, even in the traditional side. And what we're seeing both with futures in the US as well as kind of the initial 24/5 model that we're rolling out is that when volumes are a little bit lower, it's fine to maybe have some margin buffers and an ability for people to pre-fund some of this activity. But if this activity, if 24/7 trading really grows, even if it's not 24/7 settlement, you'd like to find ways for people to move risk to collateralize those over the weekend, overnight trading obligations in line with the actual trading demand. And so that's another opportunity that we see on the horizon to kind of facilitate more 24/7 markets here in the US, not just global movement of collateral.
Yeah, maybe just to echo Yuval's points on the scale of this opportunity. At Tradeweb, we trade over 3 trillion notional a day. A lot of that comes from the swaps market. A ton of it comes from government bond markets around the world. And if you look at our growth over the last, say, 5 years, our cleared swaps market has been growing 20% plus typically, whereas our cash markets have been growing sort of 8 to 10% a lot of years. So kind of like a double growth rate. And it does suggest to us that having the mechanisms for clearing, having super high capital efficiency and leverage available in the system, but that the system generally works. And I'm not suggesting the cleared swaps market can't be improved upon, but I do think it fundamentally works pretty well, and it's been a multi-decade process to get it there. And so we look at the sort of opportunity to make the back end of cash markets from the funding and repo side through securities lending, through trading, all the way through 24/7. We need these capabilities. And I think we have a huge unlock of hundreds of billions a day of potential trading velocity around the capital efficiency that Yuval and Chris are mentioning. And so it takes a lot of pieces to put it together. So the thing that excites me most now, I think, is that we have a roadmap that we can really execute on and have been executing on. So firms like Chris's taking the lead with an actual need is laying the groundwork for what we're going to use for 2,000 plus institutional firms on Tradeweb for the back end of these funding and collateral markets.
And just to kind of add to the conversation, there's kind of this concept of, well, it's in theory. We think we can do this. Maybe it'll happen. And that's just not true, right? We know we can do this. And I'm not just talking about the way I'll call it crypto native platforms operate with collateral. We have a big bilateral OTC options business, all ISDA governed. And we take tokenized collateral, stable coins or in-kind collateral for those contracts. And it enables us to think about that counterparty risk fundamentally differently. You know, if we're able to intraday call margin if we need to. Over the weekend, to Yuval's point, Tuesday at like 10 a.m., we can. And so it changes not only how we manage the balance sheet associated with those contracts, but also how we manage the counterparty risk associated with those contracts. And it's just creating a fundamentally different ability to control your risk that just previously has not been available to us.
Which, thank you. In fact, I was wondering whether these, more, one could say back office tasks, whether they have an impact or if they drive more profit or more efficiency on the front office side of things.
So this is an interesting question. It's abstract, I would say, right? It's really easy to say, I borrowed for X and I made Y, right? When we think about the back office operation in our organization, I'd be curious to hear how they think about it as well. It's really about the concept of confirming that what we think is done has been done. Right? And the way traditional markets historically have worked is there's a day cycle to it, where end of day you get your reports from your FCMs, your PBs, the exchanges, you reconcile, everything looks good, you move on. And what crypto has taught us is there is no day. It's just this continuous process. And in doing so, there's pros and cons to it. One of the cons is you now no longer have that end-of-day cycle to make sure everything's correct. The pro to it, though, is at any given point in time, we're able to confirm exactly what our position is, exactly what assets are in flight, where are they, what's available, what's encumbered. And so ultimately, that drives back to the front office because they're able to make more efficient trading decisions, make more efficient decisions about where they deploy their capital. And so I do think there is a direct line between back office efficiencies to front office value capture, but it comes down to building an operation that's able to kind of work with that flow, moving from an end-of-day cycle to just this continuous reconciliation process.
I mean, yeah, I think in terms of real P&L versus kind of like longer term cost savings, which also contributes right over time to the bottom line. I think the first mover is probably the new financing and trading opportunities with the, at least for our kind of like larger institutional members, there's some period of time where, yes, you can build automation of processes, more potentially efficient reconciliation, like you're noting, things that create real cost savings down the line, but you're probably operating on dual infrastructure for some period of time. And so, but the fact that there are actual distribution opportunities, new clients to reach by moving assets on chain, new financing markets to participate in, is kind of that good first step to say, well, it justifies building the infrastructure, even if we're operating on some dual rails for a period of time, and we don't see actual, full cost savings until you see some retirement of those systems.
Yeah, I guess for me, I'm hopeful we can move this as fast as possible. So I really, we do have the roadmap, we have the capabilities to do this now, and not just looking at you, Mike, looking at everybody, all of us. How fast we can move this, because I think there's going to be a really intense pressure on 24/7 capabilities, and with things like agentic AI coming into the mix, everyone's just assuming you can do things really fast in this world, and I think you should be able to. And so, we're really excited by a lot of the innovations we see coming from crypto, including, say, perps and RWA on the weekends, things like that. But I think that'll be a lot stronger if we can get the cash markets also to 24/7 on a fairly rapid basis. And I think that will hopefully take platforms like ours trying to be ready for the client base whenever they're ready, but also pieces like the back end of this collateral and repo and funding sitting behind that. Because you need those capabilities that Chris is describing for this to really fly. We would love to see the treasury market be able to be traded actively 24/7. And right now, I think the activity you're seeing in RWA perps is super exciting, but it doesn't have to be the only thing, right? And we've been saying this for a long time about Bitcoin, right? People trade it on the weekends because it's the only macro asset you can trade. Now, all of a sudden, you have a few other macro assets you can trade, but it's still just dipping the toe in the water in the ocean that is the underlying cash marketplaces. And I think but a lot of those pieces, I feel like the bar is even higher to get to 24/7 because you know, as our CTO says at our firm, we don't want Saturday to be the new Monday. And like Chris said, there kind of is no day. So you're going to need more automated processes is the long and short of it. You're going to want to have your AI agent kind of taking care of 90% of what you're seeing, knowing that the system's robust and the collateral moves automatically, right? And margin calls kind of happen. So it's going to take us a year or two, but I hope it's not 3 to 5. Like, I really think we need to be able to do this pretty quick.
It's not just the technology, right? It's the emergence of liquidity, right? So you need the funding markets to be there, the FX markets, the whole way that you run your treasury management switches if you're going from a day convention, right?
Netting capabilities.
Netting capabilities, exactly something, of course, we're thinking about. And so, yeah, we can build that technology, but then we need everyone to kind of move and actually have the liquidity be available in those more, 24/7 cycles.
Thanks. Okay, so we've talked about, the value that this brings. We've talked about the new rhythms and everything. If we look at the value chain and interoperability, I mean, there are lots of blockchains out there. There's a lot going on at the moment. And I hear the word interoperability a lot. So in your opinion, what is the biggest hurdle to achieving interoperability? So making sure that value can move freely, across the different blockchains and traditional bank ledgers, maybe.
As a person who's trying to maximize less interoperability, I'll answer that I think that the thing that will accelerate interoperability the most is a use case. I think that it's very easy as a customer to ask for interoperability because you don't want to take risk on a technology, which is very logical and it makes sense. The contra to that is there's just so much to do. Like, just think about everything we talked about here. So if you're building technology and an ecosystem is building technology, where do you want to divert your resources? You want to divert your resources to where you're going to get the best return on investment, right? So I always say to customers, well, if let's say we work with a clearinghouse and the clearinghouse said, well, we are willing to accept Ethereum as eligible collateral, we'll solve interoperability between Canton and Ethereum because there's a very legitimate use case that can actually drive demand. But just to build interoperability for the sake of reducing technology choice, in my opinion, is not the right use case. And there's all kinds of solutions like bridging that are out there, and they don't come risk-free. There are risks associated with them. We've done some research, for example, between Canton and Ethereum that we believe we can actually build like a native interoperability between the two networks. But it's not trivial. It requires quite a lot of investment. And you don't want to do that because it's good PR. You want to do that because people will actually use and drive value out of it.
Yeah, certainly interoperability is kind of at the heart of DTC's role in the market today, right? So how do we take hundreds of different TAs representing thousands of issuers and connect that back to a pool of millions of underlying investors through, a diverse network of brokers and custodians and access to dozens of exchanges and hundreds of ATSs. And so being the center of that, right, creates that easy movement of, liquidity and connectivity between issuers and investors. When we think about our role in the on-chain ecosystem, it's not just interoperability across blockchains, and we would like to give our clients the ability to have some choice to represent the shares they hold at DTC on the L1s of their choice that are connected, Canton being the first one that we've been able to kind of announce publicly, and where we've seen kind of really responding to client demand to access that ecosystem. But it's not just movement across L1s, it's also back and forth, right, between traditional and on-chain ecosystems. And I think that's particularly important for the collateral use case that we're discussing today. If you're moving large chunks of treasuries, right, to collateralize large obligations, that might be more efficient to do on an L1 network, but that doesn't necessarily mean that you would have full access to on-chain settlement modalities on day one. But that shouldn't hold you back, right, from realizing those operational efficiencies and capital efficiencies of being able to put the assets on chain. So if you have confidence that the tokenized asset that is on on-chain is fully fungible with actually represents the real security, and that you can transfer it back into regular way holdings within 15 minutes, you can take full advantage of that on-chain operational efficiency, new trading opportunities that might be emerging on-chain, while still having the security that if you need to liquidate in large scale, you can convert back, right, and have full access to the traditional depth of market that you'd experience today holding in traditional form. So that interoperability takes away some of the opportunity costs that might hold people back, right, from adopting collateral on-chain day one. And we think it's important to the success of our platform, as well as driving some of these use cases in the near term.
I think for us as a trading platform, the two main constraints or thoughts are we're going to go where our clients need us to be, but then also equally important, where can we build today? And so where we can build today with what we need for building apps for repo and funding has really been on Canton so far. It was just kind of designed from the ground up with institutional trading in mind. And what we see going on probably with interop is more around the distribution and moving assets where clients want to transact them on chain. But to be honest, that hasn't really hit our institutional world that much. And so I think there's actually a question around interop. I guess one other axis of interop we see is there's a lot of really exciting and substantial systems people have built in their own walls that they have to figure out how to interop either with Canton or with other networks. And so that process is hopefully well underway because people don't want to give up all their IP. Luckily at Tradeweb, we didn't have to do that. We're kind of going from our legacy trading systems. But we'll go where the clients need to be, but really being able to build, like we want to be a builder of market structure in tokenized 24/7 asset trading, and the ability for us to link into post-trade and settlement, the ability to see the state of things that have gone on, but not really have to worry, like do our institutional clients on both sides of the fence have to fear like the privacy component in particular. It just allows us to just charge ahead and build, which is important to us.
I just want to add something real quick, and this is not going to be liked by crypto kind of like hardcore people, which is I don't think that this technology's job is to get rid of all intermediaries. That's a personal opinion. And I think that one of the best solutions that are very easy to do and are very quick and generally speaking safe is actually to rely on trusted intermediaries that can provide interoperability rather than solve very complicated technical solutions that might have risk associated with them. You could actually get interoperability much faster relying on entities like the DTCC to do interoperability for you.
I mean, just even to expand on that a little bit, on our trading desk, we will trade assets across any number of different blockchains. We have our preferences for certain things, but at the end of the day, if a counterparty wants to trade one asset on one blockchain for another on another blockchain, it's our job to be able to support that. So in that way, we are kind of effectively enabling interoperability, kind of not quite as to the extent that the service providers are doing so, but I think the same kind of function exists on every aspect of the market environment. And then we will go and choose which infrastructure layer, which blockchain layer we think is best for our use case. To the point about the repo use cases and collateral mobility, we don't want the world seeing our collateral moving 24/7. The privacy layer is important, and that's why we lean into Canton for that. But there are blockchains that are good for other purposes, and it's our job to make sure that we could function on top of them as well.
I think there's a question how much the clients will end up having to see a lot of this in the back end. I think if we get it right, they probably won't have to think about it all that much. They're just going to really focus on the uplift in functionality, the reduced capital, sort of charges and efficiency, and hopefully they'll have good interfaces to these, to these sort of platforms happening in the background. So.
Thank you very much. We don't have enough time to take questions from the audience. Maybe a quick yes or no question for you guys. So, 12 months from now, do you think collateral mobility will be the standard, or will it still be niche? And if still be niche, so it's not a yes or no question. If it's still niche, how long away are we from it being a standard?
So I'm going to take a phrase that my CEO uses a lot. Markets are Darwinian. And over time, they will converge on the most efficient solution. And I think everything that we've been saying up here indicates that 24/7 on-chain collateral mobility is the most efficient solution from a balance sheet and trade financing and kind of risk management perspective. And so I absolutely think that will become the market standard. I think there'll be many different flavors of it that eventually kind of converge on some smaller number over time. And so for the next 18, 24 months, I think we're going to see some of those kind of divergent solutions emerge and then eventually kind of like converge back down to a small handful that are the market standards.
So I think Broadridge is here. They do $350 billion to $400 billion of repo a day. And again, in the grand scheme of things, it is peanuts, but it's not nothing. Since DTCC made their announcement on tokenized U.S. Treasuries, we have had inbound from, I think, 4 to 5 clearinghouses that said we should consider taking DTCC tokenized U.S. Treasuries as collateral into our clearinghouses. We'll have the first prime broker, FCM, announce that they will start accepting collateral from their clients on Canton. So I just think it's a very easy problem to sell because the impact to the end client is so dramatic. You don't have to have massive network effects. This is a bilateral between you and your prime broker, your FCM, or between you and the clearinghouse. So you don't really need to have like massive network effect to make the use case work for you. So to make it a yes or no, I think yes, collateral within a year will probably be the largest use case, in my opinion, on blockchain rails.
Yes, we'll have real applications and real recurring volumes in collateral that are in production, not POC, right? And obviously we have examples today that are already in production. Within the next 12 months, I know we're launching our collateral app chain. There's all sorts of collateral applications and use cases we've already discussed and done, seen test trades on the Canton network that our tokenization initiative will be leaning into. The scale of the existing institutional market is vast, so that doesn't mean that in 12 months you'd see the majority of institutional collateral on chain, but it will be a meaningful option that'll be available to the market.
Yeah, yes, over here as well. I guess I would just wrap up by saying once this is really there for major clearinghouses, prime brokers, exchanges, it also opens up other marketplaces to take advantage of these opportunities, right? So for example, the whole bilateral swaps market can just be made like much, much more efficient with these capabilities of programmable collateral as well. And then when you add in digital cash instruments and those being able to be movable, mintable, burnable, then I think you've got really cool applications in things like bilateral swaps, maybe even private credit, like where you can really start talking to issuers now about how do you use these digital rails to make the newly issued instruments even more exciting and programmable.
Great. Well, time's up. Thank you so much for your time. Thanks for being here. Thank you, everybody.